Welcome to the Planet MicroCap Podcast, the #1 destination for everything microcap investing. I'm your host, Robert Kraft, and each week I sit down with elite investors, CEOs, and market experts to uncover actionable insights and real-world lessons you can apply immediately. Are you a new or experienced microcap investor? Do you want to meet microcap management teams as well as other microcap investors from around the world? Planet MicroCap hosts the highest quality in-person microcap events in North America. The mission is to bring the best microcap investors, companies, and allocators together to gather, connect, and grow. Visit planetmicrocap.com to learn more about our Las Vegas and Toronto events. Now, a quick disclaimer. The purpose of this conversation is for informational and educational purposes only and should not be construed as a recommendation to purchase or sell any security. Planet MicroCap Holdings LLC and MicroCap Club LLC are not registered investment advisors. Planet MicroCap Holdings LLC, MicroCap Club LLC, its partners, contractors, members, subscribers, guests, and affiliates may or may not hold positions in one or more of the securities mentioned on this program and may trade in such securities at any time. Do your own due diligence and seek counsel from a registered investment advisor before trading in any security. In this episode of the Planet MicroCap Podcast, I'm joined by Luis Sanchez, founder of LVS Advisory, to discuss his firm's differentiated, event-driven, and global growth strategies and why he sees compelling opportunities emerging outside the crowded large-cap tech trade. Luis walks us through his high-conviction power thesis, which identifies a massive structural shortage in U.S. electricity driven by AI and data center demand, and highlights key beneficiaries across nuclear, LNG, and energy infrastructure. We also explore why LVS is optimistic about merger arbitrage and corporate restructurings in 2026, how he's positioning around global dislocations and misunderstood compounders, and why today's concentrated market environment may be creating one of the most attractive opportunity sets for disciplined, catalyst-driven investors. We mentioned a number of companies and sectors during this conversation, and I am not a shareholder in any of them. Thank you again for tuning into the Planet MicroCap Podcast, and please enjoy my conversation with Luis Sanchez. Luis, thank you for joining me today. How you doing, man?
I'm doing great. Thank you so much for inviting me back. It's been a while.
It's been a while, dude. And look, I really enjoyed our conversation that we had. Now, this won't make us feel old at all. It's only been 5 years, since since we last
Time
chatted.
flies.
Yeah, we talked some fun things on that one, dude. We talked to merger arbitrage, value traps, a little naked wines. We covered quite a bit there.
Yeah, a lot has changed. That's back when I was living in New York, and I relocated to Central Florida a couple of years ago, and my family grew a lot since then as well.
Part of the New York migration. I take it.
We definitely needed more space.
And better weather.
That too.
Well, Luis, for those that didn't hear, that our interview, way back when, give folks just, that quick hitter on, what you're looking for, what your investing philosophy, kind of how you go about, just searching for new ideas. I know that's kind of a heavy-handed question to answer in like 30 seconds, but do your best, and then we'll get into some stuff.
Yeah, I'll keep it high level, and we can dive deeper. So I run LVS Advisory, which is structured as a registered investment advisory firm. And we have 2 investment strategies that are actively managed. One is called the event-driven strategy, which is basically an uncorrelated, low volatility strategy designed to beat liquid fixed income returns. So we bench against the high yield bond index. And then our other strategy is we call it the growth fund, which is a discretionary stock picking fund. And it's basically a 30 stock global unconstrained strategy where we're just trying to find the best stocks in the world that will make us the most money. And our event strategy, it's pretty simple. I view it as like the ultimate value investing strategy because everything that we invest in, we have very strong catalysts. So typically we're looking at like corporate restructurings or merger arbitrage. And then in our growth strategy, we're really looking for just high quality businesses. We're looking for businesses that maybe are undervalued in the market for any given reason. Maybe it's time horizon, maybe it's they're misunderstood somehow. And, it is important that it's called growth strategy, not because we're like focused on hyper growth, but we do believe that having some growth provides us a margin of safety.
Very good. Thank you for that quick overview. And actually, that dovetails perfectly into one of the first things I want to get into. And the reason I invited you back on, you just put out your Q4 letter relatively recently, and I was like, oh man, I haven't talked to Luis in forever, so let's hit him up and see what goes on. So, first question actually is right on that front, having to do with your event-driven investing strategy, and my you kind of hit on where you believe your edge truly comes from on that front. But I mean, what are some specific situations that you believe the market is still systematically mispricing outcomes?
Oh, wow. Big question there. So, you know, the way that I would put it is our event driven strategy is um, fairly systematic. We're trying to balance a little bit of what I would call a systematic approach. And what that means is when it comes to like merger arbitrage opportunities, we look at every merger arbitrage opportunity out there. We study them carefully and we rank them daily on best risk reward opportunity. And we're pretty active in basically keeping the merger arbitrage situations with the highest risk reward in our portfolio and being really careful about identifying the situations that could not close or could cause us to have a capital impairment. That's one aspect of it. On the other aspect of it, there's a reason we don't call it a merger arbitrage strategy. It's because we do a lot of other kind of esoteric eventy stuff that is a little bit more open-ended. And a lot of that could really be anything. At its core, it just comes down to pattern matching. We study every type of pattern that kind of aligns with a hard catalyst thesis. And if we kind of observe and notice that certain patterns result in outperformance, we kind of dive a little deeper, or, obviously sometimes we just use common sense and say, yeah, this is why this could be interesting. So I'll give a couple of examples because it could get pretty wonky.
Oh, I was
And
about you took the
and it's
words
like
out of my
every
mouth.
year,
Yep.
it's hard to talk about because every year, well, first of all, I don't talk about some of the strategies because some of them are actually quite proprietary. But because it's also true that we discover new types of events almost every year. So one that I wrote about last year was we were doing a lot of biotech cash shell investing last year. So what that involved was finding biotech companies that were either had a failed clinical trial or had a failing clinical trial, and there was some kind of realization event to getting like the cash distributed back to shareholders. And the way that works is, right, when you're going to do a clinical phase trial, these are very expensive. Oftentimes, the biotech company will have to raise like hundreds of millions of dollars. It'll just be sitting in a bank account, just cash, and they're just allocating that to their clinical trial over time. They're kind of burning against their studies, and if something happens really early in a trial, like either maybe in phase one, a trial is proven to be like unsafe, or in phase two, an asset is proven to be inefficacious, then they might have to cancel the trial. And if they don't have any viable assets, they have very limited options of what they could do. What will often happen is, let's just say a company might have like $10 or $15 per share of cash, but because the market will put a big discount on that cash because they're burning the cash. So what often happens is you might find a biotech shell where there's like $5, where like the stock price is $5, but it has $10 of cash on the balance sheet. they no longer have to burn the cash because they just terminated their clinical trial, and that's when there's potentially an arbitrage to buy it at like 5 or 6, allow the company to liquidate, which would just be liquidating a bank account. It's like the most straightforward liquidation possible. And so we got really big into that over the last couple of years. So that's actually an example of where there was like a wave of these opportunities where today we're not really doing so much in biotech cash shell land. Just they're not trading at the same discounts they used to, although we do have a couple of positions. And that's just kind of an example of something weird. Like another example could be we have several positions on right now where a company is selling like a problematic division of the company, and we believe that the reason why the stock is mispriced is because investors either don't understand the implications of selling that division, or that division was just so bad that it tainted the rest of the company. So without giving a specific name, I'll just kind of highlight what I mean by that. So this one company we own, it's a small cap. The division that they're selling has this really nasty left tail contractual liability that once they dispose of that asset, they no longer have this kind of nasty like legal liability. And we're basically buying the stock today for what we view as like 3 times pro forma EBITDA. And we strongly believe, and we observe that whenever these deals close, that there is a lag between, the announcement of a situation like that to like deal close to after deal closing, where it usually takes some time for analysts to parse how a company has been transformed, to start to reassess and re-rate. And so that's like another kind of idea that we really like, is just finding these just really big restructurings or dramatic shifts in a company that may just be under the radar because it's either a small cap stock or an underfollowed industry or whatever. Sometimes these transactions are just very complicated, so it just takes a lot of work to unpiece all the moving pieces there.
Mm-hmm.
But we're usually just trying to find assets at pretty big discounts. We look for really, really hard catalysts where we can pretty much take it to the bank and really not have that much downside if we're exposed. And we're in our event-driven strategy, we're very diversified. So we have as many as 40 positions on at any given time.
Gotcha. So I think I'm going to continue down real quick the merger arb rabbit hole. I mean, talked about a lot 5 years ago. Why not talk about what's going on right now? Because, from what I'm seeing, it seems like 2026 might be a strong year for merger arbitrage. Whether it's deal flow is accelerating, regulatory uncertainties kind of creating some of the spreads, and mega deals are back. I mean, how do you think about 2026 when it comes to it being, whether it's a strong or year or not for merger arb?
Yeah, absolutely. Super optimistic. And actually, one of the things I announced in my Q4 letter is we're really going to double down on our merger arbitrage, in our event-driven strategy this year by launching a levered version of it. And a lot of the reason why is because we just view the opportunity set over the next couple of years in event-driven as being very, very promising due to a lot of the factors you just mentioned. So we're coming out of an environment where, deals were highly scrutinized, deal volume got crushed, and interest rates were really high. And now all those things are flipped. In 2025, we saw M&A volume surge. We saw interest rates come down. We see a much laxer regulatory environment. On top of that, because merger arb was a hard asset class to make money in for a few years, a lot of the merger arb specialists left the market. So there's literally fewer investors chasing these opportunities today than there were 10 years ago. So, we've observed this shift in the market in the last 12, 18 months. The other thing that has shifted is in my opinion, like the overall stock market investment environment doesn't look as attractive to us today. So if we're, in our growth fund, we bench against the S&P 500. And if you just look at the S&P 500, there's record valuations driven by the fact that the index is super concentrated among a narrow group of tech stocks. And on top of that, there's a very volatile macroeconomic environment right now that it's pretty hard to parse. There's a lot of trends that are kind of moving in opposite directions. So my takeaway from that is kind of two takeaways. The first is that I just don't think it's a great time to be allocating to large cap US stocks, namely the S&P 500. So on the one hand, in our growth portfolio, we're trying to take advantage of that. And by being very different from the S&P 500, we're looking at things that are underrepresented in some of those indices where we see a lot of opportunity. So we've expanded our universe in we've increased our exposure to international stocks, for example. We've increased our exposure to places like Japan and the UK. We do have a lot of, I'd say, things that are not related to the big AI market movers. That's something we're doing on the growth side. And then on the event side, we're just doubling down on what we see as a really nice uncorrelated strategy. And we just view being less correlated to those asset classes that are, appear to be very risky to us today as being a very valuable place to be.
Very good. So, I mean, on the event-driven side of things, one thing that I'm always curious about, from folks like yourself, where you're really, you kind of really focus on just, prioritizing catalysts. For you, what matters more in terms of generating outsized returns, owning a great business or owning maybe let's say a mediocre business with a high probability catalyst?
Wow. So that's kind of the interesting thing about running the two books that I run, because I think there's room for both in a portfolio. And not only is there room for both, but those two assets tend to be uncorrelated with each other, right? So usually what I would say is if you have let's call it a value situation with a hard catalyst, that will often give you more certainty over a near term time horizon of return. So if I know that this company that's undervalued today is going to have a really strong corporate restructuring this year, and on the other side of that, it's going to be a much more attractive business, well, over the next 12 months, it's probably going to be a very high probability bet to make over on the other side of that, if I have a really high quality business that has a really strong reinvestment opportunity that is maybe leaning into that reinvestment in the near term for a payoff that might not happen for 3 to 5 years, where the market might not give it full credit for that until it sees a lot of traction. The latter situation of, that company that's investing for a 3 to 5 year outcome, I would hope actually in most cases would result in a higher total return, but there's going to be a lot more. It's going to be a bumpier ride to get there typically, because things typically don't, it's usually not a smooth line up and to the right. Whereas the situation where there's a hard catalyst, it actually, what we observe is that actually that line is a little smoother, because the closer you get to that event, you tend to see the market slowly discount that event happening and slowly appreciating the output of that event. So, and my favorite situations are the situations where you start with that kind of crappy asset that has that restructuring, and then it turns into a much higher quality asset on the other side of that. And there's a really good example that I could talk about, which is, there are a handful of situations which start off as these catalyst driven restructurings that end up in our growth portfolio when we realize, oh, okay, actually this has matured into something much better. So the best example that I could give would be our investment in Talon Energy, which we made originally in our event-driven portfolio in 2024. And that started off as a post-bankruptcy restructuring situation where basically you had a collection of power plants that just came out of bankruptcy that traded for single-digit EBITDA multiples because nobody appreciated them at that time. They were kind of orphaned assets. They traded OTC. They had these big concentrated hedge fund owners that were trying to liquidate their post-bankruptcy stock. And we saw a lot of value in that situation for a number of reasons. And one of the things that we identified was that Talon had this really great data center asset that they were building, and it was co-located to a nuclear power plant. And at the time when we invested, right after they came out of bankruptcy, the market really wasn't focused on that. In fact, the market, oftentimes you'll see you have these call options, these growth call options that you just basically get for free. And the way that Talon matured in our views was that the management team just did a really good job executing towards that vision. They were the first major independent power producer to negotiate like a hyperscaler co-location deal where with that data center asset and their power center. And, they've done a number of things above and beyond what we initially underwrote. They've just been really good capital allocators, both in terms of doing leveraged share repurchases and doing really smart acquisitions. And at some point I think it was towards the end of 2024, as our thesis was playing out, we started to put two and two together and realize, there's actually a really nice reinvestment and macro thesis here. And that was, I think, the first time and the only time in size that we actually had a major position in our event book also appear in our growth book. And, now the event's played out. Like the initial event was a post bankruptcy play where we were basically, we viewed this undervalued asset that once it got uplisted from an OTC to NASDAQ, we knew it would get a bid from indexes. And that was sort of the initial thought. And we viewed that we had a lot of downside protection. And today it's really just a play on data center and AI. It's shifted. And so it's no longer an event-driven situation. We actually removed it from our event-driven portfolio at the end of 2025, but it's still one of our largest positions in our growth portfolio because we do see a continued opportunity to compound there.
Absolutely. And, this actually dovetails a little bit into another topic that I wanted to get into. And, in one of your letters, I think it was not this last one, the year end, but the one before, where you talked about the origin of kind of your power thesis. And so this kind of works really well into that. But what's real quick, what's interesting is based on kind of what you said is, you're kind of looking at some of these unloved industries, places where people are not necessarily leaving totally for dead, but, it's kind of a nice pool for event-driven opportunities. Let's say, biotech has been obvious. A lot of folks been talking about that. But it's interesting that you said on the power side thing, I guess with the Talon Energy, that kind of made sense at the time because yeah, AI and data centers, all that was kind of being talked about. It was kind of still at not as not as talked about as it is now, but love to hear how you then married all right, finding the unloved industries early, and then maybe just using the idea of your power thesis, as an example of finding stuff that, in your opinion, is a little earlier, and then watching that event driven part play out, and then ultimately, finding those few names that then make it into the growth portfolio.
Yeah. The way that we tend to work, and I say we because the team is me and an investment analyst, but the way that we work is we really do everything from a bottom-up standpoint. So we found Talon because of the event. And then once we did our reporting on Talent to ourselves, we pieced together a few things that were happening, and we uncovered the more macro thematic bet of, oh, actually, electricity prices are going in one really clear direction. And this thing we uncovered with Talon better monetizing its assets through these direct contracts with big tech seemed like that was actually going to accelerate. Um, and that's typically how we roll. Like, we find our investments mostly through screens, mostly through just reading like the news and just looking at a bunch of random companies every day, every week, and we turn over a lot of rocks. And the companies will reveal the macro bets to us, as opposed to like we're not starting from like, oh, I have some like galaxy brain idea that power is short supply because I read the tea leaves, the macro tea leaves, by looking at like commodity futures or something. It's actually the opposite. So, and the reason I like doing that is because we always start with like companies with good bones, good fundamentals, good management, good assets. And then we just try to understand like why the assets are good, right? Like, you can see by the numbers that these assets are good. Why are these assets good? Why are the results accelerating? And that's when we can put two and two together. And so what ended up happening is, we figured out the power thesis, I think, a little bit early. It allowed us to really have a really nice winner in that one stock. And we found a few other companies along the way that we've also like written up and shared write-ups on our website and in our letters. So one of them is Curtiss-Wright, which I think we wrote up last May. And what we found at Curtiss-Wright was about 1/4 of their company is manufactures nuclear reactor cores. And we viewed that segment of that company as just being very undervalued and one that would have a lot of growth momentum for various reasons. I mean, they're the sole supplier of U.S. nuclear reactor cores for large reactors. They're really well positioned in small modular reactors as well. And there's basically a super cycle right now, which Curtiss-Wright is the primary beneficiary of, where all these existing nuclear power plants are having their lives extended. And a lot of like the core, like pumps, valves, and assets that go into a nuclear reactor are getting replaced. And, just kind of following one breadcrumb to another. Another one that we actually published on, we did a stock pitch on last summer, was Golar, which is an LNG play. And, we're just like, we're finding these assets. They have good fundamentals, and we kind of piece things together. One of the things that we ended up doing, and we wrote about in our Q3 2025 letter, was, we found all these different energy and power plays independently of each other. And we just kind of realized that we stumbled upon a really interesting macro thesis. So we actually did the inverse, and then we said, okay, you know what, let's actually do a macro study to figure out what exactly is going on, like macroeconomically speaking, just so that we can better understand the tailwinds that are underpinning our businesses. And what that ended up looking like was, we did a meta study of all of the different like EIA projections of power plant additions and demand growth of the electricity grid. We compared that against like private forecasts and studies done by sell-side banks, but also energy consulting firms. And we pulled together this composite analysis, and we put a table in our Q3 letter, which basically showed like, here's how much power and electricity demand is growing in the U.S. over the next 10 years. And here's how quickly supply has responded to that. And when you look at the numbers, it's like shocking. It's the current demand trajectory is about 10 to 15 gigawatts of power demand growth every year expected for the next 5 or 10 years. And only like 2 or 3 gigs are being added. So if you sum it all up, it looks like the US is going to be short something like 50 gigawatts of baseload power by 2030. And once you realize that, then the fact that electricity prices are soaring and companies like Talon and Curtiss-Wright are seeing their stock prices soar, it all starts to make a lot more sense. And, you know, that's even before accounting for like some of these more speculative demand drivers, like when Sam Altman says he wants to build a 230 gigawatt data center. I mean, at this point, it doesn't really seem possible. But I guess if it happens, you can just multiply the amount of demand being driven. So yeah, I mean that's like our bottom up insights kind of led us down that road, and we thought it was really interesting. So we shared our analysis there.
Absolutely. So, I mean, when you kind of touched on my next question a little bit, but maybe we can, cover it even more extensively. But when you're looking at ideas like Curtiss-Wright or Talon or Golar, for instance, what were some of the characteristics about, maybe some of these companies in particular that are like, all right, after doing our deep dive due diligence, these are, might be quality ideas, but here's also why now they actually kind of play into this overall power thesis and why these companies maybe in particular are, better suited to benefit the most maybe than some other ideas that are out there.
Yeah. So, maybe I'll kind of dive a little bit deeper into Golar a bit, because I think that one really illustrates what asset quality means, but also shows like why something could be like misvalued or cheap for maybe good reasons. Because none of these stocks these stocks all have risk, right? They all have idiosyncratic risk. And at the end of the day, it's just about figuring out which risk are worth taking. So with Golar, and the way that we've thought about our power bucket is like each one of our power stocks are just very different from each other. So Golar is on the liquefied natural gas side of things. And our view is that, like, basically, because the world is so short on power, all forms of power generation get a bid. And with LNG in particular, LNG, most people would refer to it as like a transition resource because it is a fossil fuel. It is cleaner than like just burning crude oil or coal, but it's probably not something like it's probably it's not net zero, right? So it's not the thing that people want, but it's sort of the energy fuel that we can have because it's really fast to deploy, it's really easy to store, and it just works really well. So what you see is that there's places of the world, notably in Europe and in Asia, where they don't have a lot of like energy producing natural resources. So they have to import a lot of LNG. And most of that LNG, a lot of the LNG today is coming from the US, but there's a lot that comes out of the Middle East. There's some that comes out of Australia, West Africa, and Latin America. So it's really a global market, which right now the U.S. sort of dominates the export market for, which is interesting because everything that's happening in the U.S. data centers, it all sort of is priced on the marginal dollar of energy, and the marginal dollar of energy really is gas production right now. So in some indirect way, our data center growth in the U.S. is actually impacting global energy prices. But with Golar, where they're at, where they're positioned is they're I actually think of it more as like a chemicals company. So they have what are called floating LNG plants, And these are basically um, cargo ships that are converted into chemical plants. And so they're floating, and they position them offshore or proximity to some offshore production source. And all they're doing is they're just liquefying the natural gas offtake. So they're liquefying the natural gas, they're off-taking it to a carrier, and then the carrier is transporting it to Europe or to Asia or wherever they're importing energy. So there's a lot of reasons why we find this asset interesting. I mean, the valuation's one, which I'll get to in a minute, but Golar basically came up with this really cost-effective and quick to deploy energy infrastructure asset. So just because they're starting with like these offshore vessels that they're converting and they're floating, they're really cheap to deploy. So if you compare, like, a comparable land-based solution would be like what Cheniere has in the US. And just the amount of capital and it would, like with a Golar solution, it takes like $2 to $3 billion to set up one of these floating LNG rigs. Cheniere is spending like $20 to $30 billion on its plant, and it takes them like many years, like as many as 10 years to get to production, where Golar is able to get its floating solution delivered in 2 to 3 years. So it's partially a cost play, it's partially a speed play, because right now speed is so important just because everybody wants that energy now. But the other thing which makes Golar really unique is because it's floating and it's mobile, they get these really unusual contracts where they basically are able to put these offshore chemical plants in places of the world where nobody wants to underwrite a land-based solution. So they have 3 primary assets today. One is offshore Senegal. One is, 2 are going to be offshore Argentina. One of those is actually still finishing up a contract off Cameroon, and the other one is in the shipyard. But, basically what you have is you have an asset in West Africa and then 2 assets in Argentina, and investors will take one look at that and say, oh my God, I don't want to touch anything that is like doing business with Argentina and West Africa. So I think that's like the most obvious reason why Golar is mispriced, because on a surface level, it looks really scary. But then if you dive a little bit deeper, then you see, oh, okay, actually, Golar only does business in US dollars. All of Golar's counterparties are investment grade. So in West Africa, their counterparty is BP, which owns the production source that they're sending the natural gas from. In Argentina, they're contracting with this entity called CESA, which is a consortium of a bunch of very reputable oil and gas companies. And they have a really special agreement with Argentina, which basically gives them, it's governed by English law, and it gives them a 30-year uninterruptible, uninterruptible, oh my God, I can't speak.
Oh, you got
a 30-year export license, which makes it, according to the rules that it's written, it makes it so that the Argentinian government can't change the taxes, can't change the quotas. It's a very firm agreement. And the other thing that's beautiful about this business is, if there is an issue with their counterparty or the projects that they're working on, well, it's a floating vessel, and it can just pick up anchor and go somewhere else. And based on our research, there's like dozens of places where they could put these, and hundreds, if not thousands, of viable offshore sources of natural gas, which could make sense to contract for these. So, and these are done on 20-year contracts. So, yeah, it's a really interesting asset. It's very unique. And we think it's super undervalued. So the stock today is in the low 40s. And we think that the existing assets today are worth anywhere from $80 to $100 per share based on um, basically pure multiples. And so that's you get the existing assets at anywhere from like a 50 to 60% discount, and then you basically also get the upside for free, which the upside is there's two sources of upside. One is we believe that they're going to build more assets. They have a really strong business development pipeline, and we think that there could be as much as $50 per share of incremental value created from their pipeline. And they also have all these. The way their contracts work is they get a fixed toll, so it's a very steady cash flow business, but they get upside if energy prices spike. So we don't really value the commodity upside very highly. I don't think anybody does, but I don't think you really need it for the stock to work.
Absolutely. So thank you for the Golar example right there. And look, a lot of the examples that you've given so far, between Curtis Wright, Golar, Talon, did I say something?
Talon.
Talon, these are large players in the space, obviously that have appreciated, in the last couple of years here, but they're probably, I'd say they're more in the, higher end, small cap, lower end, mid cap type companies. You know, look, we're a micro cap pod. I figured I'd ask, how should folks be thinking about, this power thesis when maybe assessing and looking at companies that maybe don't have as as large of assets as maybe some of these other companies do in order to participate and grow their businesses under this power thesis that you're using?
Yeah, I mean, the energy space is really is a great industry to be in because there's so many different ways to play it, and there's really the full spectrum of micro, mid cap, large cap. We picked our spots very carefully, and the reason why we picked Curtis, Wright, Talon, Golar is because we don't really view ourselves as having a lot of commodity price risk per se. That's not really where we think we're going to have an edge. I don't have any super strong view on like predicting, oil and gas prices in the next 1 to 2 years. But an area that where we have spent a lot of time on and at times participated in is like royalty rights. And there's a lot of royalty businesses out there, really in any commodity. So we've actually found a lot of really interesting like small cap oil and gas royalty plays in the past. And we've also found some really interesting ones in like the precious and industrial metal side. So I find that to be very interesting. And the reason I like those, and to be clear, I don't own any royalty companies today, but the reason why we theoretically like those and have in the past owned those is because you have a really clean business model, right? Where all you're doing is you're collecting your check, you're letting the oil and gas companies that are doing the more risky, capital intensive part of the business take the risk with their balance sheet, and yeah, like that tends to be a beautiful business.
For sure. Yeah. No, I mean, listen, I thought I'd ask. I mean, especially in our neck of the woods, there's a lot of picks and shovel plays, right? There's a lot of tech names that are, helping some of these, um, energy producers be more efficient. There's a lot of data center plays in our space. So I figured, why not ask to see if there was anything that, maybe you would. How about this? Let me ask it like this. For those that that are playing in our neck of the woods, the sub billion. What are some of the red flags, green flags that folks should look out for when now they're saying, yeah, no, we see the power thesis, we get it, we want to be part of that power revolution, and we need to make sure that we have all this, and this is what we're doing. What are some of those red flags, green flags that folks should really look out for when assessing certain businesses that are trying to be a player here?
Yeah. So there's sort of a live by the sword, die by the sword um, factor in some of these markets, where if you're dealing in the sub billion space, and this was definitely the case with Talon when we first found it, is there tends to be a lot of concentration, either asset concentration or customer concentration. So, for example, if you might be like an energy play, but you're really just an energy play for like one very specific basin or region. Um, or you might be a data center play, but you're only a data center play for like this subset of AWS data centers in this part of the country. And, you know, there's good that could come out of that, right? So if the asset that you're most levered to um, appreciates, you're going to get levered appreciation. But if you get something wrong there, you're going to have more downside and more risk. So that's like the first thing that I think about in that neck of the woods. And we see that a lot. I see a lot of these like small caps in these like cyclical markets where they're really exposed to like one thing or one big customer. And, maybe that big customer leverages their negotiating power and things don't work out well. And I've seen that quite a few times. But at the same time, one of the things that's happening in the data center space is all these companies are providing services to data centers are basically grifting the tech companies, because the tech companies have unlimited money and are just desperate to get capacity up and are paying huge premiums for all these services. So that's why all these engineering construction companies that are building power plants are getting premium bids. It flows down. If you're an electrician and you're willing to go to some remote place to hook up a data center, you're probably going to get a premium contract there, so on and so forth. And there is some risk here. And one of the things that we're seeing is there's a lot of indirect, up front, I alluded to this idea of, oh yeah, the S&P 500 right now looks really risky to me because it's really concentrated among these large tech companies. And that's and betting on those companies would be a direct risk. But in the industrial space right now, there's a lot of companies that have just significant indirect exposure to that same risk. And I'm not sure a lot of people really understand that. Because when the numbers are going up, everybody kind of overlooks the fact that, oh, this company has 3x the normal organic growth because they're just getting all this unusual data center activity or data center contracts. But I for right now, it's clearly a factor in the market. And somebody gave me this really interesting, made this really interesting point to me, which is, I think the way they put their investment strategy to me was they want to sell everything the tech companies are selling, which is their shares. And they want to buy everything the tech companies are buying, which is like data centers, chips, and power plants. So that was an interesting way to put it. And I guess if you follow that, you probably would be doing pretty well in the market right now.
Oh, no, absolutely. So, I mean, Luis, my final question then for you here today, because I listen. We started from event driven strategy. We made it. I think we've settled in on what you've basically been spending your most time on, which is, power and power plays. Is probably what I'm going to title this pod, if I'm just being honest. Um, I want to also talk nuclear a little bit, because especially in small micro cap land, there's been a handful of companies that always, that are developing the next version of nuclear fuel or nuclear infrastructure. You know, help us demystify, maybe some of the on the nuclear energy side of things and why, you know, just really should just what's your thoughts on kind of the nuclear energy infrastructure industry right now and how folks should really think about it, at least in your opinion?
Very, very complicated space. So I am aware that there's some companies in microcap land that either have some kind of niche, either in like procuring nuclear fuels or doing like reactor waste disposal. And some of those seem like pretty interesting contracts to have and interesting assets. And I think there's a lot of tailwind supporting those types of business models right now. On the other side, I've also looked at some of the companies that are in this race to create better nuclear reactors. And I think that's a pretty tough business to be in, um, for a bunch of reasons. So, one of the reasons I like an independent power plant or a Curtiss-Wright is because they're sort of platform agnostic, right? So if you're a power plant, you're just going to work with whatever the best technology is, and whoever makes that, right? And what I like about Curtiss-Wright is they actually have content with most of the companies involved, like most of the technology. So they have contracts with TerraPower, they have contracts with Rolls-Royce, they have contracts with GE. And, I want to be clear, I'm not a nuclear expert. Um, and I don't personally believe that I have an edge on figuring out if NuScale is going to be better than TerraPower or X Energy. And I think there's just a tremendous amount of uncertainty there, honestly. Uh, so I try to stay away from picking like those types of winners. Although I do think that like the services businesses are very interesting and probably durable.
Very, very good. So, Luis, we're pretty much there. Final thoughts, going forward here in 2026, any other industries, things that you're looking at that, have piqued your interest?
Good question. So thematically, I mean, we look at so many. We probably go through like 2 or 3 companies a week on average, and we're really intrigued by housing affordability right now, for a number of reasons, and we don't really have. This is just something that we're researching. We don't really have any plays in this sector right now, but we're considering some, and the reasons why like there's like 2 or 3 reasons, but first, like everybody, it's pretty obvious that I guess one theme here is when I talk about Talon, I talk about like just a mismatch in supply and demand in the power market, and we clearly see that in the housing market as well. And not only do you have that clear mismatch, but there's a lot of political will right now to make housing more affordable, and there's a lot of ways that could manifest. Home building activity has been pretty weak lately. So has like mortgage origination, and just general construction outside a data center has been pretty weak. So we're looking at those areas, and I think that there's a lot of really high quality businesses there that that we're studying and that we may add to the portfolio. Another like more thematic thing that we've been looking at And again, we start bottom up, but we look at enough things bottom up to where we say, okay, these are all connected somehow. Like these are all interesting for like a connected reason. But another place that we've spent a lot of time is media. So as I wrote about in our Q4 letter, we have a pretty big position in Netflix. We've had it for a long time. And through our very deep diligence on Netflix and the entire media ecosystem, we've just like been periodically been studying a lot of companies there. And we own just like a basket of these, let's call them mid-cap media companies, aside from our Netflix holding. And our kind of view is that with all the consolidation that's happened in like on the streaming side, there's been a real war over like quality content. And so we've been we think a lot of the content that's being sold is going to be sold for higher amounts of money in the future. And so, everything from like live entertainment to just like really good like storied franchises that like scripted that just have really good IP that have a lot of optionality. So what that could mean, in some cases, like it's a video game company with a lot of intellectual property that has clearly articulated a strategy of monetizing that intellectual property through TV and movie agreements. Like that's a big angle that we're looking at with a few different companies. But also just live entertainment, which we view as like a really critical wedge for these streaming companies to acquire viewers and subscribers. So we've been watching that space really carefully, and we think it's very interesting. We just view this longer term tailwind of streamers continuing to spend more and more on quality content. And yeah, that's something we're excited about and working on.
Very interesting.
And maybe in one of these categories, we definitely I'm really big on, we do deep diligence and then we publish our work. And I'd encourage everybody who finds what I'm talking about interesting to follow me on Twitter, sign up for our email list. And we try to publish 3 or 4 high quality pieces of investment research every year. And hopefully we'll have something interesting to write about soon.
Very cool. Well, I was going to let you off the hook, but now we got you brought up the Netflix thing, and now I got to ask and be that annoying, like talking head on every financial network. So real quick, yay or nay, you think it goes through or not? I have to ask.
Well, according to the prediction markets, I believe Paramount is expected to beat Netflix as of mid-February.
On the Polymarket or Kalshi? Where's the arbitrage on is there an arbitrage between Polymarket and Kalshi yet?
There's got to be an arbitrage, and I might need to incorporate that into my event-driven approach. But,
for sure.
I look at the antitrust argument, and I don't see Netflix closing the acquisition with Warner Brothers. I think it could get through US antitrust regulators, but I have a much tougher time believing that it'll get through European regulators for a couple of reasons. I mean, one just being, if you look at what happened with Activision Microsoft a few years ago, that wasn't anti-competitive. I mean, anywhere near the scale of what this Warner Brothers Netflix deal would be. And that got just insane antitrust scrutiny. I mean, granted, it was a different antitrust regime, but I think that the scale of what of what we're trying to accomplish here is very different. And then if you look at some of these European markets, um, Netflix actually is the number one media company, and Warner Brothers is a top 3 media company in a lot of these like niche, like European countries. So I have a hard time believing it'll go through. And so, we still own some shares in Netflix and in our growth strategy. We we initiated our position in 2022. It's been a really good investment. And yeah, Netflix's stock has traded off like 40% from the high. Um, we sort of view the situation through the lens of at this price, we think the outcome will be pretty good with or without a deal. Without a deal, we think the fundamentals are really strong. The company has executed really well, and we see continued compounding organically. With the deal, there's a lot of execution risk. The balance sheet gets worse, but we think the company would have a tremendous opportunity to get value out of just basically the best content library in the world. And in fact, I think it's such a powerful combination that I do think it's anti-competitive. So, um, with or without the deal, I think we're okay. Continuing to hold our investment here, and it's been interesting to watch as somebody who does a lot of event-driven investing, because I get a new like headline almost every day about why the deal is going to go one way and then goes the other way. But yeah, we're sort of watching it. We're not really playing an arbitrage in that deal right now. We're just trying to see. We're just waiting for the outcome there.
Absolutely. All right. Well, Luis, this is a great place to end it right there. We covered a ton of stuff here today. I'm sure we'll have you on, hopefully not in another 5 years, hopefully sooner than that. But, Luis, with that, where can our audience, what's the actual URL that people can go to subscribe to the newsletter as well as follow you on social media?
LVSadvisory.com.
Very cool. All right. Well, Luis, thank you for joining me today. Really do appreciate it. Good luck. Stay safe. I'll see you soon.
Thank you. You too.